looking back in 2020 and 2021, if I looked at the charts,
Hmm.
what would I say is happening? I would say it looks like a war. That was before the actual war that's happening now, basically. But of course, that adds to it. And one of the unfortunate things of war is that basically inflation leads to war, and then war leads to inflation, right? So it's kind of like if you ask people why did World War One happen, why did World War Two happen? It's like, well, there's no one reason. Basically, you had rising powers, you had falling existing powers, and those came to a head. And things, of course, could have worked out differently, but they didn't, and they worked out the way that they did. And so throughout the 1930s, you had rising populism around the world. You had various economic discontent, and when people experienced that, they tend to turn to more extreme views of things, and they turn to leaders that tell them these people are causing your woes. If we go after this, we can make things better. And more often than not, those are often kind of cruel misdiagnosis of what's happening. But people believe it because they'd rather have someone forcefully tell them what the answer is than to someone kind of say, we don't really know the answer. It's a lot of answers. We have to work through this. And so economic stagnations tend to lead to more conflicts, physical conflicts, and economic conflicts and cyber conflicts in the modern era, things like that. And so in part, the United States has, we've been the global hegemon for quite a while. We control essentially the global reserve currency. Like I said, most emerging markets are basically financing their deficit, their debts in dollars in significant part, which means that we can kind of harden their liabilities whenever we want to, which is challenged. We can sanction, we can cut them off. And so there's a number of entities that would prefer to have their own payment rails, their own financing structures. And the biggest, of course, would be China. They don't want, now they're the largest commodity importer in the world. By some metrics, they're a larger economy than the United States. I mean, they produce more energy, they consume more energy, they have more skyscrapers, more people. Um, you know, uh, if you look at a purchasing power parity, for example, they are bigger than the United States. Um, and by some other metrics, they're still smaller. They don't have they don't have anywhere near the same military. They don't have the same nominal GDP quite yet, partly because the dollar is so strong. But basically, they're now rivaling in scale the United States, but they're still in many ways subject to dollar payment rates, and buying energy in dollars. And so for many years they've had an interest in developing their own payment systems and being able to buy energy and commodities in their own currency. Same thing with Russia. They want to build a sell outside of the dollar-based system, and they want to be, they wanted to have their own. Um, that's part of why they were stockpiling gold, for example. You can't freeze their self-custody gold in the same way that you can freeze their dollar or euro denominated assets. And so, on one hand, I do think we're seeing a rising of a multipolar world economically. So instead of one dominant superpower dictating and running the payment rails, I think we're seeing a more spread out type of power structure. So this goes back to World War II. When World War II ended, the United States had almost all the gold. Most other places were economically, physically devastated by the war. The United States was barely touched other than Pearl Harbor. And so they were basically over 40% of GDP, and they could dictate terms. But over time, as you've had a recovery in Europe, as you had a recovery in Japan, as you had the rise of China and India, now the United States is something like 20% of global GDP, a little bit more or less depending on how you want to measure it, nominal versus purchasing power parity. But either way, it's very hard to be that sort of unipolar hegemon when you're 5% of the global population, 20% of their GDP. It's a much more spread out world than it used to be. And I do think that our financial infrastructure is going to start resembling that. I think that there's going to be diverse payment rails. I do think that you could see kind of just alternate, currencies and payment structures. Um, but I think, well, it's still going to be remain to be seen how that's going to play out. But what you have in common is that Russia, China, India, Brazil, uh, many of them, some of them produce commodities like Brazil and Russia. Other ones are big commodity importers like China and India. And what they generally have in common is that they want to be able to trade without asking permission of the United States. When you focus on a lot of things, there's certain
Mm.
small markets that you just have to kind of accept that you're not going to be able to follow closely.
Yep.
And so, for example, the past couple of years, I have heard about the opportunities in tin, and it's just something that I've said is probably correct. It's just I don't have the bandwidth to go into the nuts and bolts of what's happening in the tin market. And so in general, when you have commodity bull markets, there's a lot of macro forces behind it. Usually it's kind of a weaker dollar. It's usually associated with more emerging market growth because that's of course where the marginal demand for most commodities comes from. And you have this kind of natural, capex cycle where you go for a period of time of underproducing until you get a price squeeze. Then the price squeeze triggers more production. You eventually get to overproduction. That's when you get the next bear market. Weak production for a while, and you kind of go through these 10, 15, 20-year cycles. And a lot of those commodities kind of go along a similar route. Not they might not spike in the same year, but generally good decades for commodities or bad decades for commodities tend to impact the majority of commodities. And so my overall approach is to kind of have a scattershot, diverse commodity exposure, especially to the big ones like the various energy and copper. I also like fertilizers. I like kind of a broad array of commodities. And I'm not, when it comes to the smaller commodities, I think I would leave that to people that focus every day specifically on the commodity sector. They have more time to dedicate to those small markets, and the advantage there is that they can find things that a lot of investors are not looking at. Well, so they're hybrids, right? So they have a monetary premium and they're also used for some commodities, especially silver is the hybrid. Gold's more of a closer to a pure monetary type of asset. So I do look at things like the copper to gold ratio, for example, or the oil to gold ratio. Generally, of course, you'll get gold outperforming during decelerating economic periods, and then you'll get other commodities outperforming during rising economic periods. They could obviously both be going up or down together, but generally the ratios at which they're going up or down will be impacted by whether or not the global economy on average is accelerating or decelerating. And so, there are years where I might favor gold over copper, another year where I might favor energy. So, these things are mostly going to be cyclical timings. I'm generally bullish on the whole complex, including precious metals, most likely for this decade. The precious metal story obviously is a little bit different of a structure. Rather than focusing on the lack of capex, instead I would focus on that's more of a demand story. And so from the 1970s all the way to 2008, we generally had declining global reserves of gold. Basically, these countries had gradually reduced their gold holdings. They were holding more treasuries. Starting in 2008, that trend reversed. So you fell from something like 37,000 metric tons to 30,000 tons of official global reserves of gold. And then since then, we've built back up to the high 30s again, something like 37,000. I haven't looked at the exact number recently. And we've had very big gold purchases, late last year. And I think it's going to continue. I think it's part of the multipolar world thesis, where instead of holding a lot of dollar or euro denominated assets, I think a lot of these BRICS nations and BRICS plus a lot of emerging markets in general are going to hold a more diverse array of reserves. And that, for some that do a lot of trade with China, that can include a little bit of yuan around the margins, but it can also include a lot of physical gold that they buy and that they custody.